Hello everyone, welcome back to another video. If you're new to this channel, my name is Farhan and I help accounting students like you ace their exams. Today we have got a practice question which requires you to identify the types of errors that are involved and also prepare the relevant journal entries to correct these errors. We will also understand how the profit is affected once we correct these errors. You can see the question on the left hand side of your screen, and on the right hand side, we have all the workings, which I'll go through and explain step by step. What I need you to do now is focus and follow through for an excellent understanding. With that being said, let's begin. Tom Company's financial statements were prepared for the month of January 2024. However, upon further checking, the following errors were discovered. So here we have identified four different types of errors, and our requirement is to name the errors and also prepare the journal entries to correct these errors. So let's look into the first error which we have got. The wages and salaries account was overstated by $600, while the motor vehicles account was understated by $600. All right, so what's happening here? Here, we are understating our assets, which are the motor vehicles, by $600, and we are also simultaneously overstating our expenses, specifically the account for wages and salaries, by $600. Now, what's happening is that assets and expense are generally debited when they always increase. But here, you are decreasing the assets and increasing the expenses, as a result of which the net effect for the total of debits is ultimately zero. Okay? And this type of error is what we refer to as a compensating error, where errors end up canceling out each other. Okay? Now, how do we fix this? What's the journal entry to fix this? So basically, we know we understated our assets, which is specifically the account for motor vehicles. Now we need to increase our motor vehicles by $600. Motor vehicles is an asset account. Now that we have to increase an asset account, we have to debit it. So we debit the motor vehicles account by $600, which basically reflects the increase in assets. And simultaneously, we would want to reduce our expenses, which is to reduce the account for wages and salaries. So how do we reduce expenses? We know when expenses increase, we debit them. So now that we have to reduce it, we will credit it. So we credit the account for wages and salaries by 600, which basically reflects the decrease in total expenses. All right. Now, after that, after we have corrected this journal entry, what should we do next? We need to understand how the profit is affected based on this correction which we have done. So when we are crediting wages and salaries by 600, we are essentially reflecting the fact that our expenses are decreasing by 600. So when expenses are decreasing by 600, our profit should go up by 600, simply because profit and expenses have an inverse relationship to each other. And the reason is that we calculate profit simply as the difference between total revenue and total expenses. If our total expenses are going up in value, we will end up subtracting more from total revenues, as a result of which our profits are going to go down by $600. Okay? All right. So let's move to the second transaction which we have got. Proceeds from the sale of an old equipment, $5,000, had been debited to the cash at bank and credited to the sales revenue account. All right. So this type of error is what we classify as an error of principle, where we have recorded the transaction in the wrong category. And the wrong category here is that we know we have sold a non-current asset, which is different to selling our inventory to our customers, right? So because we have sold a non-current asset and we ended up recording it as a sales revenue, which is indicating that you may have sold to your customers, this type of error is what we classify as an error of principle, because the error is within the fundamentals. Sale of non-current asset is a different category in itself compared to the sales revenue, which is only sales that you have made to your customers, right? So this is where the wrong categories are involved, and we call this an error of principle. Now let's look into the error that was actually made. So when this transaction was recorded, we ended up debiting the cash at bank by $5,000 simply because that's the money or the proceeds that we received from selling that equipment, right? But we ended up crediting the sales revenue account by $5,000, which is the wrong entry that we have done here, which is mainly the error of principle. So what do we do now to fix this? To correct this, we want to decrease the sales revenue. So how do we decrease the sales revenue? Revenue, whenever it increases, we credit it. But now that we have to decrease it, we end up debiting it. So we are debiting the sales revenue by $5,000, and simultaneously we are crediting a separate account known as the sale of non-current asset account by $5,000. Okay, so once you have made this correction through this journal entry where you are debiting sales revenue by 5,000 and crediting sales of non-current asset by 5,000, what's the effect on profit of the correction? When we debit the sales revenue by 5,000, we are decreasing our sales revenue by $5,000, right? We understand that profit is calculated as the difference between revenue and expenses. Now that we are reducing our sales revenue, our profit is going to be directly affected by the amount of the reduction in sales revenue. Therefore, our profit is also going to be decreased by $5,000. Okay? All right. So let's move to the third transaction. A credit note of $900 was issued to Team Limited during the year. This had been debited to Team Limited's account and credited to sales returns account. What do we understand by a credit note which we issue? A credit note is only issued when we have confirmed a sales returns that we accept from our credit customer. And in that case, the customer is Tim. Okay. Now, before we can identify the type of error that is involved, I need you to look into the error that has been made and what should have been the proper way to record this transaction initially. So, first of all, we need to understand how should we have actually recorded this transaction initially correctly. Okay, so when the error would have been processed, we would debit the sales returns, because sales returns, when it increases, we debit it. Sales returns basically reduces the amount of sales we had originally made. Because our customer team had returned some inventory to us, we ended up issuing them a credit note. And when we issue a credit note, we are actually recording our books some kind of sales returns. Whenever we record sales returns, it's always debited. So we debit sales returns by 900, and we would have credited the account for Tim, trade receivables team, by 900 to reflect the fact that the balance Tim owes us is now going down in value simply because Tim returned us $900 worth of inventory, which we have just confirmed by issuing a credit note. And the reason that is why we are debiting sales returns by 900, right? So this would have been the correct way to record this. But look at the error that was made. The error that was made was basically the exact opposite which was recorded, where we ended up debiting trade receivables team by 900 and crediting sales returns by 900, right? So you can easily see that the correct entry was the exact opposite to what we have actually done. And that is why this type of error is known as an error of complete reversal, where the whole thing is just basically reversed and inverted. All right. Now, how do we fix this? Now, based on the original transaction, we know that the sales returns amount was $900, and the reduction in the account for trade receivables team should also be $900, right? Sales returns, when it increases, we end up debiting it. And trade receivables account, which is an asset account, now that it will go down in value because team has returned us some goods, we need to reduce it and we would end up crediting it, right? So we want to make sure that our final balance for the sales returns account is 900 debit, and the final balance for trade receivables is 900 credit, based on the original transaction or the event which took place, right? Now, how do we fix this journal entry? So this is the error we have made. How do we go from here to here? So as we understand, the final balance in the sales returns need to be 900 debit. The original balance of sales returns, which we recorded when we made the mistake, was to credit sales returns by 900. How do we go from credit sales returns 900 to debit sales returns 900 as a final balance? We end up debiting sales returns by 1800, And what's the logic? If we debit sales returns by 1800, first of all, the 900 debits cancels the 900 credit entirely, and then 900 more is left, which is what will be shown as the final balance on the debit side. So we end up debiting sales returns by 1800. Simultaneously, for the account for trade receivables, we know we need a final balance of credit 900. So the error we made was to debit trade receivables team by 900. So how do we go from debit to credit 900 net balance? We credit trade receivables for the account of team by 1800, where first the debit 900 gets entirely canceled out, and then we're left with 900 surplus, which is what is being reflected here when we credit trade receivables team by $1,800. Okay. So basically, every time you're fixing an error of complete reversal, your numbers would be doubled so that the original mistakes which were done are first completely erased, and then the net balance reflects the amount which should have been initially recorded, if that makes sense. All right. Now, once the journal entry to fix this has been done, what's the effect on profit? Now, we understand when we debit sales returns by $1,800, we are essentially increasing our returns. And when our sales returns go up by $1,800, our net sales revenue should go down by $1,800, right? Because we have got some returns. And when our net revenue goes down by $1,800, our profit is going to be directly affected by the amount of reduction in net revenue. Therefore, our profit is going to be affected by $1,800. Okay? All right. Now, the only way you can get better and better with questions like this is sufficient practice. And I'll be sure to upload more videos on these topics, which you can check out later. Now, let's look into the last transaction, which is transaction number 4. Accrued utilities amounting to $1,500 for the month of 31 January 2024. Sorry for my mistake. This should be 2024 based on the original question, as you can see. So accrued utilities amounting to $1,500 for the month of 31 January 2024 had not been recorded in the books. So this transaction was forgotten. So what type of error is this? This is pretty straightforward. This is what we classify as an error of omission, all right? When the transaction was completely forgotten to be recorded. Now, it's pretty straightforward. If you want to prepare the journal entry to fix this, we know we had got an utilities expense. Now that we have to increase our expenses, when we increase our expenses, we debit them. So we will debit utilities expense by $1,500, which is basically reflecting the fact that expenses are increasing in value. And at the same time, we know it is accrued. The question clearly specifies that this is accrued and this hasn't been paid yet using cash, all right? So accrued utilities expense is a current liability simply because it's a present obligation and we have to take care of it very soon. So when liabilities increase, we end up crediting them. So we are crediting the account for accrued utilities by $1,500, which is basically reflecting the fact that current liabilities are increasing in value. So what's the effect on profit? As you can understand, we are increasing our expenses when we are debiting utilities expense by $1,500, which means expenses are going up by $1,500, and definitely due to the inverse relationship between profit and expenses, profit has to go down by $1,500 simply because profit is calculated as the difference between revenues and expenses. Okay? All right. So I believe you have a proper understanding of what's going on with the different types of errors which we have identified. First of all, we identified the errors of compensating errors. Then we identified errors of complete reversal, errors of principle, and lastly, the error of omission. All right. So that's all for today's lesson. If you found value in this content, make sure to drop a like and subscribe to this channel. And you can check the link in the description to book a free Zoom call with me and discuss your coaching requirements to help you prepare for the exams at the end of the year. With that being said, I'll conclude today's lesson and I'll see you in the next one.